Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Well, we've been seeing a very volatile session of late, and this is after the US federal meeting that happened overnight. And also we did see that decision of 25 bips hike coming through, although that was on expected lines. What we also saw as comments was coming in on the fight that may continue on inflation front. So we could anticipate more hikes coming forward from here. Now, what does this decision really mean for the Indian markets at large, and how are experts really deciphering the kind of strategies that you as investors must follow in this current market scenario? We'll get down to discussing that with our special guest today. But first up, a quick check on how the markets are doing at this point in time too. The markets have now slipped into the red. They are near the lowest point of the day. 17,107 currently for the Nifty. That's down about 50 odd points. The Sensex hovering near 58,000 now. 170 points of a cut is what you can spot. So 0.3% of a decline for both the major indices. But when we also look at the broader markets, for example, the mid cap 100 and the small cap 100 indices as well, the small caps are lower by about 0.3% odd, again near the day's low. Also, when we see the mid cap 100 index, that's also seeing a cut of about 0.3 odd percent right there. The India VIX levels, they are lower by 3 odd percent at 14.3. But the sectors that have come under pressure now clearly are Nifty Bank, which has now seen a cut of half odd percent, led by the decline in PSU banks. That's seen a cut of 1.5%. Also, financial services, private banks, all three constituents have slipped into the red. The royalty pack is seeing a cut of 0.8%. IT sector is dragging the street to 0.8% of a fall for that one as well. The only gainers at this point in time, and that too with a far and few between gainers, and that too very minimal percentage gain, is what you can see on the metals pack, on pharma, on FMCG, and absolutely flat move on the auto index. The market breadth has shifted towards the declines now, with 29 declines to 20 advances as far as the Nifty 50 stocks are concerned. Among the declining stocks, you do have stocks like Asian Paints that are falling the most, about 1.5% on the index. SBI, HCL Tech, Wipro. So the IT stocks clearly big laggards. Bajaj Auto seeing a cut of 1.5%. On the gainers, however, you do see Hindalco, that's up by 1.5%. Some of the gainers also include from the auto back, and that's Maruti, that's up by 1.2%. Of course, news reports suggesting price hikes coming across models starting April. Bharti Airtel, Nestle, JSW Steel, the other gainers at this point in time as well. With time now to welcome our guest on the show, Mr. Nipun Mehta joins in. He's a market expert and well known at that. Many thanks, Mr. Mehta, for joining us on this edition. Well, first up, I wanted to begin by understanding your take and your key takeaways from the US Fed meeting and the commentary of Jerome Powell that we saw. Was it on expected lines, and what do you really anticipate going forward from here should be the kind of action that we can expect from the RBI, our own central bank as well?
Good afternoon, Sakshi, and thanks for having me on the show. So the 25 basis point hike by the Fed last night was probably on expected lines. Big event out of the way, but the uncertainty in terms of inflation, interest rates still continues. Uncertainty as far as the strength of the banking system in the US, again, still open to question. One would have felt a lot more confident and reassured if there had been a lot of reassurances or talk as far as the banking system was concerned, as far as the stress tests or any incremental stress tests that might have been announced or that might have been there. In addition, whatever regulatory oversight, increased regulatory oversight that the Fed might have wanted to do, any announcement of that would have raised confidence levels as far as the banking system is concerned. So all of that is something which one would have loved to see in order to ensure that there was a lot more stability on the markets, on a lot more confidence on how the Fed would move in terms of the potential interest rate trajectory that might be there for the rest of the year. I think that also lays ground for RBI to look at how inflation in India and how interest rates in India have panned out. And it does probably warrant another 25 basis point. One would think that's a likelihood as far as RBI is also concerned when it meets sometime the week after. And one would believe that that rate hike would probably be one of the last ones that we might see as far as India is concerned. Again, depending on how the inflation pans out post that and how the interest rate hikes have had an impact as far as growth in India is concerned. Clearly, growth in India has been affected. Earnings would get impacted to an extent when one sees the March quarter earnings, given the hike in interest rates or past hike in interest rates. But yeah, that lays ground for probably a lot more stabler interest rate regime for the rest of the year as far as the domestic economy is concerned.
Right. But Mr. Mehta, could you help us understand, to your mind, what exactly are the financial markets really penciling in at this point in time? Are they penciling in the peak of the interest rate cycle very soon? Have they already started to price in a slow recession or a slowdown as well in the second half of the year? What exactly are the markets thinking?
So I think there has been a fair amount of fear that both the US and Europe would go into a severe recession. Probably the inflationary impact hasn't been to the extent that the central banks, their economies there have got impacted by, which raised hopes to an extent, and there were expectations that probably instead of a recession, one might have a slowdown and a gradual one at that. I think uh, uh, the bank problems for the SVB as far as Signature Bank. Both of these have really created additional uncertainty as far as the banking system is concerned, as far as the economy is concerned, as far as how rate hikes further could be there, as far as quantitative tightening is concerned, as far as currency movements are concerned. So I think it's increased uncertainty, and that's where I come from when I say that Fed saying additionally on the stress as far as the banking system is concerned, or the extent of support that they might give. They did announce Yellen did mention that they might not have further insurance for the deposit holders, but any confidence on as far as the banking system was concerned would have really lent support as far as
Sure.
confidence on the banking system as well as the economy.
Sure. But I want to understand from your own experience, for the benefit of all our viewers, most of who are investors into the equities as well, over the years that you've been investing in equities, how much importance do you really pay to the macros and the developments across the world, like the ones that we are seeing right now, and also the Fed commentary, the interest rates, before deciding on your investments in equities?
So clearly, when one is investing in Indian capital markets, I think the domestic macros is a huge differentiator, and one needs to focus more on that as opposed to global events on a longer term basis. On a shorter term basis, yes, probably these kind of large events do have an impact on Indian markets. That it create more volatility. It creates probably a degree of lack of confidence on the extent of ripple effect it could have on various economies, on growth, on the global growth, on potential impact it could have on certain industries within India. But that's only for the short term. On the longer term, I think what matters really is the domestic growth and the kind of corporate earnings that really come by, and what kind of an impact these kind of interest rate hikes in the domestic market, as well as whatever movements that happen as far as the currency markets are concerned, how much impact that will have on corporate earnings. I think those are about the key points as far as domestic macros are concerned when one looks at
Sure.
corporate.
Sure. What would you anticipate as the key triggers now for the markets ahead, now that the big event is over and done with? We've also seen the regulatory, actions to, prevent a contagion of the banking crisis to spread pretty fast, and they've been pretty proactive this time around when we compare with the 2008 crisis. So most of the experts have been saying that we are not likely to see an event like the 2008 crisis, but we are still, looking at how the scenario is playing out. The key triggers that could really impact the markets and the trajectory going forward from here. Do you believe there are enough legs and enough tailwinds to pull markets out of this volatile and consolidative period that we've been seeing?
So as far as Indian markets are concerned, I think two events over the next few weeks are going to be key. One is, of course, the RBI meet that will be there, and what's the view that RBI has as far as inflation is concerned, as far as growth is concerned, and interest rates are concerned. Of course, as far as currency is concerned, because there are hopes gradually that once the interest rate cycle in the US peaks out, there could be a potential appreciation as far as the Indian rupee is concerned. So that's something that views of the RBI would be important. I think the most important would be, of course, the corporate earnings, which one will
Sure.
start seeing in 2 or 3 weeks' time, and what's the impact that higher interest rates or continued sort of weakness in the rupee have had as far as exports are concerned, as far as broad corporate earnings are concerned. I think these two would be key as far as domestic markets are concerned.
Okay, now that we've been discussing a lot how this is changing in the global markets, for Indian markets as well, the interest rate hike fear still not behind us, financial crisis still unfolding, the world economy slowing down. We are seeing all of these factors really play out. How have you really changed your investment positioning, your portfolio positioning at this point?
So I think as far as investments in India are concerned, like I said, for the long term, a lot of these global macros do not have a major impact, unless, of course, one is investing in a company which is largely dependent on exports, and where potentially there could be a slowdown as far as export orders are concerned, given
Okay.
the impact on sort of global growth is concerned. The moment you have global growth slowing down, you have a lot of export-oriented companies which potentially could get hit. So I think what we've looked at over the last few quarters is ensuring that there are more domestic-facing companies uh, with relatively or almost no leverage, which probably are likely to throw up far more consistent profitability and growth in earnings quarter on quarter, as compared to those which are more leveraged, which would have got definitely impacted by interest rate hikes, as well as got impacted by slowdown in global growth.
Okay. Any pockets that you're bullish on now and you want to stay away with from right now in the current market scenario?
Well, there are sectors and sectors which probably give a fair amount of confidence as far as India is concerned. Banking clearly stands out given the cleaning up of overall balance sheets are concerned, and strengthening of balance sheets, and one sort of uh, differentiates or distinguishes that from the extent of uncertainty that's been created by either of Credit Suisse and or SVB in the European as well as the US market. So given that fact, I think the Indian banking system far more robust and cleaner. Uh, uh, the capital goods space continues to look very interesting given the kind of continued flow of orders and fairly robust execution that is there. So that's one space again which is likely to continue to show a fair amount of growth. Uh, we believe there could be a degree of uncertainty as far as IT is concerned.
Yeah.
If there is that slowdown as far as order flow is concerned from both from Europe and US.
Mm-hmm.
Uh, that's something which probably needs to get watched for a quarter or two in terms of order flow, order execution, uh, and which could potentially change any view as far as IT is concerned. But yeah, there are some of these sectors which do infrastructure again looks to be positive given the kind of spending that's likely to be there in the election year. So yes, there are the 3 or 4 spaces which look fairly we are fairly confident on, and which are likely to show up fairly decent or consistent top line and bottom line growth.
Okay, okay. On an overall benchmark index perspective as well, we are just days away from the beginning of the new financial year. While the current scenario may continue to be volatile for the markets, given the kind of, changes we are seeing globally and the macro concerns still weighing on. But overall, for FY24 as a whole, what is your view when it comes to the kind of market returns that one can expect if somebody is planning like 1.5 years prior, looking at a long term, short to a medium term perspective to put their fresh money into the markets? What kind of returns can one expect?
Well, traditionally, depending on whether you're investing in large, mid, or small stocks, uh, one has had there would be a typical range historically what has shown up anywhere from say 12 to 18% in terms of depending on the kind of segment one is investing in. But I
Yeah.
think FY24 is just likely to be a little more challenging for the broad markets. There will always be specific pockets or individual stocks which have which will overcome the challenges that are likely to be there. And higher interest rates and is likely to be one of them very clearly, where companies which are fairly highly leveraged or which are likely to have a fair amount of capex are likely to face those headwinds in terms of higher interest costs. So I think some of those challenges, as well as challenge of global growth coming back, how fast one is likely to see global growth coming back, and companies which are export oriented, which are looking at international markets for their revenues. So some of these companies, some of these sectors are likely to face those challenges, and which is the reason why our anticipation is that while FY24 could be challenging, there will be pockets which will give higher returns. But on a broad index level, if one is able to get anywhere from 10 to 12% return, I think that should be fairly encouraging.
All right, understood that. Well, thank you so much, Mr. Mehta, for being with us on the show and discussing with us all these insights about the markets going forward. What kind of trajectory can we expect, the key factors that could impact the market directions going forward, and the strategies that investors must adopt. We're looking at the market slipping away. About 300 points of a cut is what we can spot right now on the Sensex, 57,928. So we've given up that 58,000 mark on the Sensex. The Nifty is still above 17,000, but down about 77 odd points or half odd percent at the current moment, drifting lower towards the lowest point of the day, and pressure coming through especially from the Nifty Bank and all those constituents, and heavyweight counters really looking at some cuts right now. So we may be snapping that 2 days of a move on the upside that we looked at in the last two trading sessions. But keep an eye on the markets, and do stay tuned with us on to Business Today TV. Don't forget to subscribe to this platform, and also you can continue to engage with us on our other social media platforms like Facebook, Twitter, LinkedIn and Instagram. Until then, many thanks for tuning in.
Yet another global icon, a brand with a presence in more than 80 countries.